A few episodes back, we tested the Golden Cross, a 50-day and 200-day moving average crossover, famous for showing up in financial headlines maybe a handful of times a year. Today, I'm testing its faster, less famous cousin, a 10-day and 30-day crossover, reacting to price swings measured in weeks instead of months. Same core idea, completely different personality. I'm coding this faster crossover system and backtesting it on 10 years of real Google data. No cherry picking, no curve fitting, just the raw numbers. Every moving average crossover system, no matter which specific periods you choose, is built on the exact same underlying logic. Track a fast-moving average and a slow-moving average, and treat the moment they cross as a signal that momentum has shifted. What changes dramatically, purely by adjusting the length of those two averages, is how the system actually behaves in the real world. A 50-day and 200-day pairing, like the Golden Cross, filters out almost all short-term noise. It only reacts to genuinely major, sustained shifts in trend, which is exactly why it fires so rarely. A 10-day and 30-day pairing does the opposite. It's tuned to catch much shorter-term swings, reacting within weeks rather than months. That responsiveness is a double-edged sword, and it's worth understanding both edges before assuming faster is automatically better. This channel has now tested moving average-based systems spanning a huge range of time horizons, from the 52-week look-back of the momentum strategy down to this 10-day fast average, one of the shortest look-back periods covered so far. Lining these results up side by side, across many episodes, starts to paint a genuinely useful picture. Not just does trend following work, but specifically at what timescale does trend following seem to work best? Which is a much more actionable question for anyone actually trying to build a real strategy rather than just admiring one in isolation. Moving averages themselves predate almost every other tool covered on this channel. Long before Wilder's indicators, before Appel's MACD, and long before personal computers made complex calculations trivial, traders and statisticians were already smoothing out price data by hand, plotting simple averages on graph paper to filter out day-to-day noise and get a cleaner read on the underlying trend. The specific idea of watching two averages cross, rather than just reading a single smooth line, emerged gradually over the early to mid-20th century as chart-based technical analysis matured into a more systematic discipline. What's interesting is that there was never one official pairing of periods declared as correct. Different traders, working independently across different decades and different markets, converged on different combinations that suited their particular trading style, from very short-term pairings like the one tested today, to the multi-month Golden Cross, to everything in between. The advantage of a faster system is obvious. It gets you into a genuine new trend much earlier. By the time a slow 5200 system finally confirms a trend change, a fast 1030 system may have already captured weeks or even months of the move. In a market that trends smoothly and persistently, that early entry can meaningfully improve returns. The disadvantage is just as real. Faster reacting averages are, by definition, more sensitive to short-term noise, random day-to-day wiggles that don't represent any genuine shift in the underlying trend. In a choppy, directionless market, a fast crossover system can flip back and forth repeatedly, generating a rapid sequence of entries and exits that each capture only a small, often unprofitable move before reversing again. This pattern is commonly called whipsaw, and it's the single most common criticism leveled against fast-moving average systems specifically. Individual growth stocks, including large, heavily traded names like Google, are particularly prone to this kind of short-term choppiness. Daily headlines, analyst rating changes, broader tech sector sentiment shifts, and general market volatility can all cause meaningful day-to-day price swings that have little to do with the company's actual longer-term trajectory. Exactly the kind of noise a fast-reacting crossover system is most vulnerable to misreading as a genuine trend change. Here's exactly what I tested. Dual moving average crossover, 10/30th day EMA, applied to Google, using 10 years of daily price data. Starting capital was $100,000. The entry rule is precise. By the exact day the 10-day exponential moving average crosses above the 30-day exponential moving average. For risk management, I'm using the same volatility-adjusted trailing stop used throughout this channel, 2 times the average true range. I chose Google for this test to add another major individual tech stock into the mix alongside APL, MSFT, TCL, and NVIDIA already tested on this channel, each with a genuinely different volatility profile and growth story, giving us a broader picture of how the same style of strategy performs across different kinds of large, well-known companies. So how did this faster-reacting crossover system perform on 10 years of real Google data? The strategy executed 36 trades, with a win rate of 41.7%. Total return came in at plus 19.2%. Working out to a compound annual growth rate of plus 1.8% per year. For comparison, simply buying and holding Google over the same period returned plus 904.7%, or plus 26.0% annually. The strategy's maximum drawdown, the largest peak-to-trough decline an investor would have had to sit through, was minus 35.4%. The trade count itself tells an important part of the story here. A fast 10/30th system will almost always generate meaningfully more trades over the same period than a slow 5200 system tested on the same stock. That's simply a mechanical consequence of using shorter, more reactive averages. More trades means more chances to catch genuine moves early, but it also means more exposure to whipsaw losses during choppier stretches, and more cumulative impact from trading costs in a live account. Even though this backtest doesn't explicitly model commissions or slippage, there's no universally correct choice between fast and slow moving average pairings. It's fundamentally a trade-off between responsiveness and noise filtering, and the right balance depends heavily on the specific character of whatever's being traded and the trader's own tolerance for frequent, sometimes false, signals. A trader managing a large, diversified portfolio might reasonably prefer the fewer, higher conviction signals of a slower system, simply to reduce the operational overhead of managing many simultaneous positions. A more active, hands-on trader focused on a small number of names might find the earlier entries of a faster system worth the added noise. It's also worth remembering that neither speed is inherently better in some absolute sense. Each one is simply making a different bet about how markets actually move. A slow system is implicitly betting that most meaningful moves develop gradually over months, and that most short-term price action is just noise unworthy of a reaction. A fast system is implicitly betting that meaningful information gets reflected in price more quickly, and that waiting for months of confirmation means giving up too much of the actual move. Both bets have been right at different points in market history, which is precisely why comparing them directly on the same underlying stock is so instructive. Comparing this result directly against the Golden Cross backtest from a few episodes back is arguably more valuable than either result in isolation. Same core philosophy, same underlying approach of buying strength, but two very differently tuned versions of essentially the same idea. A useful reminder that the specific parameters chosen for a strategy can matter just as much as the strategy's core concept itself. Two traders can each claim to be trend followers and still produce dramatically different results, purely based on how quickly their tools react to the exact same underlying price data. That's the dual moving average crossover strategy, coded and backtested on real data, the fast, responsive cousin of the Golden Cross, put to an actual mechanical test, and a useful data point for anyone still deciding how quickly they want their own trend-following tools to react. If you want to see more classic strategies tested this way, no hype, just numbers, subscribe.